Welcome again, everyone. We're going to go ahead and get started now. Thank you all for joining us. This is, our annual look ahead to the coming year. It's been our most popular webinar for several years, and it's turned out to be that again this year. Really excited to have Aaron Rolnick and Jonathan Cook with us here today. Before we get going on the actual content, though, we'll just cover a couple of logistics as the remaining people continue to log in. First, questions. We will hold questions till the end, but you can ask a question at any time. On your control panel for Zoom, there's a little icon that you can see Q&A. You can click on that at any point and type in your question. It will go in the queue for us to be able to answer, and then we'll address those at the end. But just one request of everyone, please, and that is be sure to use the Q&A dialog box to put in your question and not the chat box, because they are kind of two different things. We monitor them differently. The most popular question, of course, in all of our webinars is, can we get a copy of the slides? So just to remind everyone from when you signed up for this, not only do you get a copy of slides, what you actually get is a recording of the entire video. So everyone who's registered today, whether they're able to make it in here in person or not, will get a link to a recording in just a couple of days. And we encourage you to share that recording with others in your organization or others who you think would be interested in hearing that. So today we're going to, of course, start. We'll give just a moment here. We'll introduce our panelists. But Aaron's going to lead off with addressing significant trends in the field and how he sees those extending into 2023. Then Jonathan's going to be talking about LifeSpire of Virginia's strategic initiatives and really how, given these trends that Aaron is addressing, what as a community, as a multi-site organization, how are they looking at this and what steps are they taking to address those challenges? I'll be closing with a little bit of some more specifics on a couple of opportunities to drive revenue and to help with staffing challenges. And then we'll open up to Q&A. Our goal is loosely to be done with the presentation part right around 1, maybe 1:05 or possibly a couple minutes after that. And we use the rest of the time until 1:30 to address Q&A. So we welcome your questions as we go. With that, again, I'm really pleased and very thankful that Aaron and Jonathan have taken the time to help prepare their thoughts and do rehearsals with us to be able to bring you and share with all of you, their thoughts on the year ahead and how we as a senior living field can and should be addressing the challenges that are out there. But for those of you that may not know our speakers that well, Aaron, could you lead off and give us an introduction?
Great, Rob. Thanks so much again for the invitation to be on this panel today and being on this webinar, and it's a pleasure to participate with you and Jonathan. For those of you who don't know HJ Sims, we are a privately held investment banking firm that's been around since 1935, and we provide financing solutions and advisory services to senior living providers all around the country, both for-profit and not-for-profit. I've been with Sims for over 25 years. I'm co-head of all of banking at Sims and also head of our not-for-profit investment banking team. We have 25 bankers that focus in this sector. And in addition, and part of what also influences my vantage point is that I am on the board of governors, the finance committee and strategic planning committee of a large senior living provider in the Washington, D.C. area where I'm based, and I'm chair of their housing boards as well. So again, thanks so much for the opportunity to be here today and share my thoughts.
Great, thank you, Aaron. Jonathan, could you share a little about yourself?
Sure, thank you, Rob. I'm Jonathan Cook, President and CEO of LifeSpire of Virginia, formerly Virginia Baptist Homes. I'm going into my 8th year working with this organization. And well, we're going to tell you a little bit more in depth about LifeSpire of Virginia. I will say that the strategies and the successes that we've had in the last few years would never be accomplished without just a fantastic team, from our department managers to our executive directors to our C-suite leadership and our home office team. I'm just blessed and fortunate to have a great team around me and us to help us advance our organization.
Great. Thank you, Jonathan. And again, this is our largest webinar of the year. We may have people coming in that aren't really that familiar with Love & Company. So myself, I'm Rob Love. I'm the president and owner of Love & Company. And Love & Company is a marketing, sales, research, and creative branding firm that specializes solely in the senior living field. And we've been in the field for almost 30 years now. And for the last 25, senior living has basically been the only thing that we do. So we like to share our thoughts and ideas with the field and share, and be able to invite other people to share theirs as well. So thank you all again for joining us today. So with that, I'm going to hand over control to Aaron, and he will get us started.
Great. Thanks so much, Rob. And here we go. So before I share some of my thoughts about where I think we're headed in 2023, I just wanted to take a few minutes to reflect back on some of the trends that we've seen in 2022, particularly those that may carry over into 2023. But certainly, the labor markets have really dominated the discussion, but I really want to reframe our discussion more around margin compression. And so what do I mean by that? Certainly, wage pressures have been a significant component of that. So obviously the underlying cost of labor, right, and the higher wage rates that are demanded. So that has an impact, from an expense perspective, but also certainly the impact on the revenue side because of the inability oftentimes to bring new revenue online or the ability to operate at full capacity. Certainly, another big story has been the pretty significant rise in interest rates, and I'll talk about that a little bit more in a moment. But from an operational perspective, that's also had significant impact. For those people who are borrowing new money, they're borrowing at a much higher cost of capital. And so that is also adding to the burden on operations in terms of absorbing that debt service. But also many senior living providers in the lower interest rate environment had been able to refinance some of their outstanding debt, and those interest rate savings had enabled them to offset the burden of increased labor costs. So obviously in a higher interest rate environment, the ability to refinance and reduce your debt service burden has gone away virtually. The other piece of it, obviously, is when we think about new projects, new construction. So the cost, as interest rates have gone up significantly for new capital, that has put pressure on the economic viability of new projects. I think a big question, particularly for 2023, is the impact of mortgage rates and the significant rise in mortgage rates and what impact that's going to have on the overall housing market. I think it's a little bit too early to tell. We're hearing anecdotally some people saying that that is starting to have an impact on the sales cycle. I know Rob will talk about that a little bit more later, but interestingly enough, some of what we're seeing is with the higher mortgage rates, people have not sold their homes because of what does that replacement housing option look like. And so it's actually reduced the supply of available housing, and at least for now, kept home values a little bit steady. But again, I think that's a big question going into 2023. The other big headline that we hear a lot about, and particularly when I talk more about the Federal Reserve, has been the impact on inflation. Clearly, we are all feeling that in terms of the cost of supplies, the inventory that we need to operate our community, but certainly also the cost of construction, labor rates related to construction, and the impact on the viability of new projects. Organizations we continue to hear are raising their monthly and entry fees in double digits. It's not uncommon anymore for us to hear somewhere between 8 and 12%. Not only with those annual increases, but more and more we're seeing mid-year increases. But I think the most important piece of that as it relates to margin compression is even with those significant increases, it's not enough to offset the higher cost of operating our communities or new projects. And that's having an even bigger impact on margin compression. Obviously, we know the complexities of operating our communities in this environment. We've talked about the labor shortage, the labor market, having to do training with all of the turnover that's occurring, but also we're seeing significant reliance, particularly in the healthcare side, on reliance on agency staffing. And obviously that is a huge burden from a cost perspective as well. Talked about already the difficulty in bringing new revenue online or launching ancillary services from a staffing perspective. We continue to see a lot of organizations think about the levels of care that they're offering, repositioning beds, or even selling or downsizing beds. And we know that with the consumers today, they continue to want choice, and obviously that comes with costs. Despite the fact that operators, I think, are doing everything that they can to address these challenges, clearly there are factors outside of management's control. We know that kind of the prolonged and cumulative effect of decline in occupancy, primarily related to COVID, has had a strain on organizations' financial position, a decline in their liquidity. While certainly various federal and state fundings were really the lifeline for organizations during the pandemic and to address the labor crisis. But now that a lot of those funding sources are no longer available, it's like the Band-Aid was ripped off. And I think a lot of those federal funds and state funds and other grants really masked some of the underlying challenges that a lot of organizations have been facing. And now that those funds are no longer available or are more limited, it's really exposing a significant financial strain for organizations, and we're seeing a relatively sharp decline in their financial position as a result. What's not helping certainly is the decline in the investment portfolios, particularly since many organizations, as we know, rely on investment income or realized gains to support their operations. We all continue to hear about the significant increase in acquisitions, mergers, and sponsorship transitions. This area has grown exponentially for SIM, certainly over the past 30 months or so. And it's really being driven, by the financial impact related to COVID, as well as the labor markets, but also it's being fueled by the escalated construction costs. A lot of organizations that were looking to expand or develop new campuses from a growth perspective, because of the rising construction costs and interest rates, are instead looking to growth through acquisitions or sponsorship transitions as a lower risk proposition and a more cost-effective way to grow. But we are seeing kind of that continued bifurcation in the market between those organizations are weaker and are having to seek partners in order to survive. But we're also seeing strong organizations continue to take advantage of the market to pursuing growth strategies because of the current environment that we're seeing. And I'll circle back to that a little bit later. Obviously, the labor situation is exacerbated by leadership turnover. We saw kind of an unprecedented amount of kind of C-suite leadership retiring coming out of the pandemic. Perhaps many people had planned to retire later, but kind of the psychological and physical aspects of managing through the pandemic had its toll. And at that time, investment performance was good, so people were retiring early. But again, whether it's at the C-suite level or up and down throughout the staffing within your organizations, a lot of early retirements, people obviously no longer or exiting the workforce. And with the decline of available labor, it's taking a lot longer to fill these positions. And then for those people who are qualified and for real talent, obviously it's the cost of acquiring that talent. And we're seeing many organizations rely on outside resources for interim positions, again, whether it's agencies or interim CFO, CEO, et cetera. From going to the financial piece again, in terms of limited debt capacity and access to capital, they are certainly related but are also separate issues. So when we think about debt capacity and my prior comment around margin compression, obviously, if we have less excess cash flow to support debt service and we have higher interest rates, it means that we're able to afford to borrow less. Obviously, the market continues to be volatile, predominantly because of these inflation concerns. And again, we'll talk about that in a minute. But in general, we're seeing a lot of money flowing out of the bond funds. We're seeing a lot of consolidation among the banks, and the banks are certainly becoming much more conservative. But whether it's the bond market or the bank market, it's certainly seeing much higher rates, restrictive terms, and covenants. So to kind of hammer that point a little bit further, while we're still in a relatively low interest rate relative to the past 30 years, obviously the big story has been the significant increase going back since March of this year in action taken by the Federal Reserve. Since the beginning of March, the Fed has raised rates 6 times for a total of 375 basis points. We expect another 50 basis points when the Fed meets next week. So if you look at where the 10-year rate was about a year ago, around 1%. Currently, we're at about 2.7%, but just a month ago, it had risen as high as 3.4%. So about 2.4% increase from a year ago to a month ago. And on the 30-year, the municipal market index went up from about 1.48% to 4.14%, so over 2.6%. And thankfully, over the past month, that's declined by about 60 basis points to about 3.5%. But again, because of what we're seeing with the Fed action and particularly the sharp increase in rates, that's really been the story and the challenge. And also given where the yield curve is, we're starting to see short-term, the cost of capital for short-term bank debt actually to be higher than long-term bond debt in today's market. Again, part of that rise in interest rates is also driven by the fact that up until December 1st, we've seen that 42 of the 47 weeks saw net outflows from the bond market, so about 131 billion in outflows in total, which really translates to a decline in the assets among the bond funds by about 25%. So again, these are the bond funds that typically invest in senior living financing. So again, that's less cash available to support the financing needs for our sector. Just quickly, in terms of some of the other tax-exempt issuance trends more broadly within the municipal market, year to date through the end of October, saw an issuance of about 340 billion, but that's down about 16% year over year. But if we look at the tax-exempt issuance for senior living providers, that decline was even more significant, about 31% year over year. We're seeing average coupons around 5%, but yields are up about 70 basis points on average, around 18%. But rates, the yields are up even higher for lower credit, for a non-rated provider, or certainly even higher for expansions and for startups. The other important piece to point out is that in 2022, there are about 65 new municipal bond issues with a par amount of over 3 billion that were reported to either be in some form of distress or have defaulted. It's still a relatively small percentage considering the $4 trillion total. But as relates to senior living, almost half of those defaults within the industry have been for senior living providers. So almost 50% of the defaults within the municipal bond market have been within the senior living sector. So obviously that impacts lenders' perspective on our market. That trend continues even if we look beyond just the tax-exempt market. We think about issuance overall, both for-profit and senior living. Volume is down precipitously since 2021. You can see about almost 11 billion in a decline in volume. And from the NIC MAP data, you can see that the number of senior housing units that are under construction across their 31 primary markets is at its lowest point since 2015. So that is the decline in new construction is really not necessarily a bad thing as it relates to its impact on occupancy. And what this graph shows is that obviously in the beginning of the pandemic, there was a lot of new product that had been put into the market, a significant decline in occupancy and inability to absorb that product. But as, again, the capital markets have become more constrained, as the amount of new construction that is coming online has been reduced, that has had a positive impact on absorption of that inventory. At the same time, obviously, that the improvement in the senior demographics continues to grow, which is also helping to fuel that increase in occupancy. And that's not dissimilar to what we saw coming out of the financial crisis in 08 and 09, with the decline in occupancy, but very little new product. And so there was a strong occupancy recovery coming out of the financial crisis as a result of those similar factors. So just to show that in a little bit more detail, this is, again, some NIC data around occupancy. This looks at kind of the low point and high point in occupancy between the first quarter of 2020 and the second quarter of 2022, as compared to kind of the average current occupancy, again, across various levels of care. Obviously, the widest gap was within skilled nursing, about a 12.6% variance from high to low, currently around 79%. Medium occupancy within skilled nursing, majority assisted living, about a 10.5% variance, again, a little bit better than skilled nursing, about 79.7%. But really, independent living has fared the best, only about a 9% variance between the low and the high. Average occupancy today around 85%. And I suspect if you were to differentiate between entrance fee communities versus rental, you'd see that occupancy within entrance fee communities is slightly higher than it would be in comparable rental communities. What's also been interesting is that kind of the lifeline for senior living providers during this crisis has been the divestiture of assets to generate liquidity and reduce the operating burden, primarily through the sale of skilled nursing and assisted living beds or entire facilities. And we are seeing really record price and demand for those beds and for those facilities. But what we're starting to see now, and I suspect when you see third quarter data, is that as capital has become constrained, particularly for for-profits, because most of these sales have been of units that were owned by not-for-profits to for-profit providers, that you're going to start to see those price per beds to come down. And where we've seen a more significant decline has been for assisted living units or assisted living beds, as opposed to skilled nursing. So where do we go from here? Where do I anticipate, what do I anticipate 2023 to look like? Again, I doing my best to put on my crystal ball. But again, we anticipate we're going to see continued consolidation, primarily through affiliation. But I think, again, what people need to keep in mind is that the opportunities are abundant, but many of them are distressed situations. And so, and I know Jonathan will talk about this a little bit before, for those stronger providers, there's not a lot of appetite to take on distressed situations, particularly as providers continue to deal with their own operational challenges at their existing communities. I think we're going to continue to see not-for-profits sell healthcare assets to for-profits, but again, at lower prices than before. I think we're going to continue to see not-for-profits pursue acquisition opportunities of a lot of that for-profit rental product that came online and that has been slow to ramp up. And so there are bargain opportunities to acquire for-profit rental assets. Again, attractive because those acquisition opportunities are at a lower cost than new construction in today's environment, but also as a lot of not-for-profits see these acquisition opportunities as a way to diversify product, get into the rental market, and as an entry point in serving more middle and moderate income. But again, we expect that higher interest rates and capital constraints are still going to moderate new construction and again, decrease the sale prices. From an occupancy perspective, we expect occupancy to continue to increase given the growth in the demographics and again, less new product that's coming into market. We're seeing less reliance on agency care. We're seeing the labor market in general improve. So hopefully that also means that organizations will be able to have the appropriate staff in place to be able to ramp up that occupancy. But again, the big question is the potential impact of higher mortgage rates on the housing market. And again, is that a real effect in terms of a reduction in home prices, or is it the psychological effect that we saw coming out of the prior financial crisis, where maybe home prices have come up over where someone bought their home initially, but maybe they're not able to realize the same amount that they could have, 6 months ago. And so it's that psychological impact of the thought that there's a loss in value there. We anticipate that life plan communities will continue to evolve if the economics support it. Continued growth in satellite or alternative venues for assisted living, not a lot of growth, obviously, in healthcare. The continuation of the trend that we're seeing, which is the shortening of the care continuum, people coming in older and more frail, but also wanting those options in their home. And we do anticipate organizations will continue to reduce their the burden, the expense burden, and the challenges in operating healthcare beds through reduction in skilled nursing and even in some cases assisted living as well. I think technology is a critical discussion. Clearly, there are so many opportunities to enhance operation and services through the application of technology, both in terms of it from an infrastructure perspective, as well as operational efficiencies. I'm not going to go into the specifics of the bullets here, but I think the important takeaway is to ensure that you are adequately budgeting for this infrastructure and operational technology, and budgeting for the acquisition of the technology, the training related to that technology, and ultimately for the implementation of that technology. It really can't be an afterthought. From an interest rate and access to capital, while we expect the Fed to continue to increase its target rates, we do anticipate that the rate of increase will decrease when the Fed meets next week. Again, we anticipate it to be a 50 basis point increase, which is lower than the prior 4 increases at 75 basis points. We do expect that at some point they're going to stop increasing rates as we towards the last part of 2023, and may even see rate reduction going into the first quarter of 2024. And while certainly the Fed policy has helped address the sharp rise in inflation, we're seeing the peaks 8+%. While we're still in a high inflation environment, we are starting to see the Fed policy help. But again, that is different than the reality on the ground for consumers who at the grocery store are seeing the price of eggs, milk, et cetera, up 30 or 40%. So the Fed still is wrestling with how do we address some of the broader inflation numbers versus some of the underlying realities that are on the ground. And now there's even talk about, increasingly talk about a recession. And so that's certainly going to impact how the Fed reacts going forward. We'll see market volatility because of a lot of the geopolitical environmental factors, obviously with Ukraine and Russia and how that plays out, China, et cetera, and that will continue to contribute to uncertainty in the market and volatility. So again, we continue to look at how do we broaden access to capital. Many senior living providers continue to look at opportunities for environmental, social, this whole ESG platform. It may not have an impact on rates per se, but it may broaden the pool of investors, particularly given the net outflows from the bond funds. But it's not all bad news. Certainly other opportunities to consider in higher interest rate environments is to rebid out your trustee held funds, your debt service reserve funds at much higher rates, but also given the volatility within the market, there's an opportunity for providers to buy back their bonds at significant discounts. So if that's a strategy you're interested in pursuing, certainly speak to me or speak to one of my team members at SIM, should you have the excess cash flow to be able to do that. So finally, recommendations for 2023. I always encourage organizations to ask themselves the tough questions. Where are we going as an organization? How well are we positioned to continue our mission in our current state or in partnership in some form? And as we seek partnerships, how do our values, sponsorship, and influence, mission influence we seek as a partner? Are we aligned? Particularly the culture piece is critical. I want to emphasize to providers, continue to closely manage your cash flow, monitor your cash flow, continue to invest in your communities. There's still a lot of new product that has come online. You need to be in a position to market well against all of that new supply. Certainly keep an open and transparent dialogue with your board, right? Want to make sure that you're not having to make decisions in a crisis. We continue to see organizations that wait too long to ask for help, where they'll call us and say, we're going to be running out of cash in the next 6 or 9 months. Obviously, call us sooner. We are here to help. We really want to make sure that you have options in pursuing, navigating out of these challenges, and waiting too long can really limit those opportunities. But I think in general, there still are positives here. Now is the time to plan so that as things improve, you're in a position to take advantage of the improvement. We certainly saw this coming out of the financial crisis, that those organizations that were ready to go really benefited once the market improved. But again, we are a resilient sector, and we are certainly stronger when we collaborate and partner with each other. So with that, thank you. And Jonathan, I'll turn it over to you.
Thank you, Aaron. I'll take just a second here to hand control over to Jonathan. And Jonathan, we'd love to hear some of your thoughts on how your organization has been responding to the kinds of challenges that Aaron just described.
Thanks, Rob. Thanks, Aaron. Great job. It's a pleasure to be with everyone today. And I just want to thank Rob and Aaron for allowing me to join their panel. Today, what I hope to go over with everybody, if this is working, Rob. There we go. I'm just going to tell you a little bit about LifeSpire Virginia, some of the evolution of our strategy, some of the revenue strategies that we're looking at implementing and the ones that we're implementing, as well as some of our strategic partnerships, some of our challenges with recruitment, retention, and then what we see next for the industry. We don't have a magic bullet either. I know everybody out there is struggling with labor challenges, with inflationary challenges. One of the things that Aaron said that really resonated with me was, these increases of 8 to 12%. We just implemented an 8% increase for independent living, an 8.5% for assisted living, and a 10% for skilled nursing. And I was telling some of my peers about that, and several of them said, yeah, we needed to do the same thing, but our board wouldn't let us. And I just feel sorry for those organizations, because that's the law of compounding interest. And if you don't do it now, you're going to have to pay for it later. So I would just argue to everybody that we all have stakeholders besides our residents. We have our staff members, our families. We have to make sure the contracts that we sign today are here 20, 30 years from now. We have to be excellent stewards of the resources we have. But we also view our investment markets and the bondholders as one of our key stakeholders. So if you don't have the discipline to do the hard things today, in these hard markets, you just have to be thinking 3, 5, 10 years down the road what that is going to mean for your organization. So Aaron, that resonated very well. I just wanted to comment on that. So this is just a map of the Commonwealth of Virginia and where our locations are at. Our ancestral home is in Culpeper. That was built in 1946, truly as a mission of the church for Baptist ministers and widows. We expanded to Newport News and Chesapeake in 1967, to Richmond in 1977 with Lakewood. We added the Glebe in Daleville, just outside of Roanoke in 2003. And then in 2019, we opened Lakewood at Home, which was the first CCRC Without Walls program in the Richmond market. And then last year, we completed our first acquisition. We like to say we welcomed another member to our family in the Summit, which was a CCRC that was part of a hospital system, Centra Hospital. And as our organization is a multi-site, we are governed by a board of directors that are positioned throughout the state, not in any one location. We've been in existence now for 76 years, and we're very proud of our tradition and history and how we serve the residents of the Commonwealth. A little bit about our story the last few years, though. It has not always been rainbows and unicorns, as they like to say. This is what we affectionately call our chuck hole graph. And the reason we called it that is our former CFO said, see, it kind of looks like a pothole. And that's what they call potholes in Indiana, where he was from. And what you can see is in 1999, it was the last year we were profitable up until 2016. So 17 years of operational deficits. And what I like to talk about is what happened in 1999. Well, in 1999, we repositioned our Chesapeake campus in Newport News with a roughly $75 million bond issuance. And what occurred is we didn't change the way we operated and behaved in our communities. And, we started to see significant losses, almost 5 million. And then in 2003, I mentioned we built the Glebe. Well, we took on additional debt there, $68 million. Again, we didn't change how we behaved and how we operated. Those two significant financings without a behavior change resulted in almost $10 million of operating losses in 2007. At that point, Virginia Baptist Homes was required to get a management company, and they hired CRSA, and you can see the trend line started to tick up until 2012. The trend lines had ticked up well enough that they were no longer required to have a management company, and our predecessors fired the management company, and you could see the trend started to go back down. At that point, we were the target of acquisitions, affiliations, all the things that Aaron had talked about, when our board basically said they wanted to give this one more shot, and brought in a new management team. And that's when myself and a few others came in. And really, at the end of the day, we just started implementing benchmarks, standards of practice, and policies, procedures. We started to operate more as a system. And since that point, we've been able to strengthen the organization significantly. Whereas now we're in a much better position to be looking for those affiliations and those acquisitions. So it's a proud story, but it was a hard road to get there. And we got there, I think, through great teamwork, great team members, and I think just some discipline and best practices. So some of our strategic initiatives that we have in 2018, once we kind of started to turn the tide financially, we did really what was our first strategic plan, which what came out of that was, how do we leverage technology better for the organization? How do we continue to invest in the future? How do we build strategic alliances to really leverage the current assets and resources that we have? We had to continue to maintain our excellence in healthcare, strengthen our financial resources, and what's really driving everything now is becoming that employer of choice. One interesting story I like to tell at this time, we started taking our board members to leading age investment banking conferences and so forth. And after starting to do that, what we realized was our board still was focused on mission fulfillment, but we also realized we had to start looking and becoming more forward focused, maintaining a long-term perspective. We had to look at different ways to diversify our people, our revenues, and our business models. And two of our trustees came back from one of those early leading age conferences And two quotes, they still stick with me today. I say them all the time. Susan Rucker said, being a non-for-profit is a tax status, not a business strategy. We all have to keep that in mind. And then one of our other board members, Bob Music, we asked him what you learned at Leading Age. And he said, I learned there's going to be minnows and there is going to be sharks. And unless we take our own destiny into our own hand, we will likely be minnows. So those are some of the things that have driven us from 2018 to our new strategic plan, which we're still in the process of formulating. We held a retreat with our trustees and a lot of our stakeholders in September. And we're still formulating some of the tactics related to the strategic plan. But some of the themes that came out of this is growth for growth's sake is not enough. Our board wants to make sure that as we grow, that one, it aligns with our mission, two, it aligns with our culture, and three, it'll benefit our existing communities and residents and members that we serve. Two, we have to continue to rebalance our communities. What that means for us is when we started doing some significant repositioning a few years ago, we recognized we were too heavily weighted to HLOCs, which is higher level of care beds, assisted living, memory care, and skilled nursing. We continue to try to add more and more independent living, and we are reducing skilled nursing in some areas that we're overweighted in those from a balance standpoint. We've targeted 80% independent living, 20% higher levels of care. I would argue that that's probably even going to be reduced 85-15 as we rebalance. We have to be excellent at what we do. Those are somewhat we like to refer to as the table stakes. We have a great reputation. We need to build upon that and make sure we don't jeopardize or put that reputation at risk. Continue to leverage our reputation and our relationships, and more importantly, our talent. Aaron referenced this very well. We have aging talent in our industry. When I look around, 4 of our 5 executive directors are, I believe, in their late 50s, early 60s. They're all going to be vacating and retiring at the same time. We've got to prepare for that through growing young talent. We are continuing to try to shift from creating a lifestyle to creating experiences for the new consumer. And then the biggest thing that came out of our strategic plan is we feel that the last 3 years, the biggest damage of COVID and labor challenges is it has somewhat eroded our culture. And we really want to get back to driving culture in our communities. It's been very challenging to do that, but that's a key focus. So as we look at growth, we look at this as 3 different ways as we talk about it. One, we have internal growth. That's the rebalancing of the communities. That's adding more hybrid homes, more cottages, more independent living. It's the rebalancing I discussed. We then have our mission growth. And over the last few years, we've done quite a bit. When I first arrived here in 2014, all we really did through our foundation was we took care of residents who exhausted their funds if they could no longer pay for care. That's roughly around $1.5 million assistance annually. However, in the last few years, we've started funding our spiritual life programs in all of our communities. We're funding a program through Cristo Rey. It's a work program for inner city minority youths in Richmond, which exposes them to the senior living program. And then we've actually partnered with 5 other CCRC's Life Plan communities in Richmond to start a diversity, equity, inclusion program for the entire city of Richmond as it relates to senior care. So mission-wise, we're expanding. The external growth is where we've actually seen a significant change. As we look at external growth, we looked at new campuses, partnerships, acquisitions, and affiliations. Well, from an acquisition and an affiliation, it's a lot lower cost than, say, a new campus, right? There's a lot less risk typically, especially if it's not a highly distressed asset. When we acquired the Summit in Lynchburg, it was 92% occupied. So we affectionately call that a unicorn. When you look at partnerships, the same thing. You're spreading your risk out against with others that share a mission and a mindset. You're adding additional volume. The biggest change for us was new campuses. We were actually targeting 2 different markets to potentially do a greenfield campus. that has somewhat been taken off the plate. The risk, the construction cost, the interest rate risk, the acquisition of land, the time, it just is something right now we and our board has said we do not want to focus on. Diversification of revenue. So moving on. One of the things that came out of 2016 was developing strategic partnerships. And kind of the first thing we did related to that was we have recently joined forces with Pinnacle Living, which is the former United Methodist Retirement Homes of Virginia. Their offices are right down the street. We operate communities in some of the same markets. More importantly, though, their mission, their vision, and the way they serve residents aligns very, very closely with LifeSpire. And 2 years ago, we started our first joint venture, which is Senior Living Partners, and it's launching a home care agency. That is going to be certainly for private pay, private duty, but also Medicare and Medicaid certified. That's in the process of launching as we speak. We should have licensure by the end of the month. We're very excited about it. But the way we view that is that actually should be a vehicle to help fund future growth for our parent organizations. We envision that likely will add a hospice, potentially therapy, PACE programs, maybe affordable housing, pharmacy, any other ancillary business line that it makes sense to operate outside of our communities. So we're really excited about that partnership. And a lot of folks ask, how is that going working with one of your primary competitors? It couldn't go great. It couldn't be going any better because we just have a fantastic relationship with the leadership team over there. Chris Henderson, Dan Nyman, Kevin Salmini, they're just great people and we enjoy working together. The other thing that we did, I mentioned it, is we created the first life plan community without walls in Richmond. Why did we do this? Well, there's a few reasons. One, our mission statement is to empower individuals with choices and purposeful living. The majority of seniors want to age in place at home. It's part of the other reason we have a home care with Pinnacle is we see our residents wanting to have care delivered in their independent living. And we wanted to have some oversight, or I shouldn't say control, but at least have a comfort level of the individuals who are providing care on our campuses. But the at-home strategy allows us to also meet this demand of individuals who would never move to our community at a lower price point. We also diversify our revenue stream because we anticipate home sales slowing down, as Aaron said. And what we did is we created a bridge program. So if a resident wants to join our at-home program, and the entry fee is around $70,000 for a membership and about $600 a month. Now, that's age rated. And if you have long-term care insurance, that pricing actually comes down. But what we believe will happen is the home sales likely will slow. People will jump into our home care program or at our Without Walls program, and then eventually bridge to our community. We're actually very excited about it. And today we're serving about 120 members in the broader community who do not live on our campus. The other thing that I was telling Rob about that we're looking at doing is really evaluating our pricing strategy. I shared with everyone kind of our evolution through our financial challenges and what we did to get back to break even. Well, one of the things that we have never done is really develop a comprehensive pricing strategy. It really just evolved. We recognized there were some things that we really needed to, I'll just say, right size within our contracts. So we've been working with Forvis to kind of rebalance our contracts moving forward. Some of our larger inventory was subsidizing smaller inventory on some of our communities, and we just had to right size that. The other thing is we were not very disciplined about increasing our resident entry fees with the housing market. The last few years, 6-7 years, we really just hit the easy button and just did 3% when we should have had a little more discipline about that. So ultimately, the other thing we want to do with this repricing strategy is simplify our contracts. If you were to look at the pricing structure for our LifeSpire communities, they are, I'll say, convoluted. But one of the things that we have done to try to appeal to the consumer is we offer both fee-for-service and life care on all of our same campuses. And that does require quite a bit of education but it also can be confusing. So through this strategy, we plan on making and simplifying our contractual pricing. So those are just some of the revenue strategies that we're implementing, and happy to answer questions about any of them. As we move on to staffing and recruiting, as I was preparing for this, I went into our software and I took a look at hires versus terminations in November. And I think this really tells the story. You can see we made some gains at Newport News in November. Our Culpeper campus was flat. Our Glebe campus, 3. The reality is, as we start looking at this, it's the same 25% of our team members who are in this continual transition. This is exactly why we want to focus on the first 90 to 180 days of retention. We don't really view this as a wage issue at this point. In the last 3 years, we've increased our wages for our team members by 37%. The average CNA was making $12.50, 2 years ago. Today, that's $23 an hour. Those are huge, huge dollars. Those are what's driving the rate increases that we're seeing. But this is why we're focusing on culture. But in addition to the culture piece that we're going to be focusing on, we also had to change our business practices. We had to be nimble. We had to employ a new applicant tracking system through Hireology. That enables our team members, our hiring managers, to use a phone. New applicants can apply for a job with LifeSpire with 5 fields, and they can do it in 1 minute and 30 seconds. And then we use bot technology to continue the communication and dialogue with candidates. We've implemented sign-on bonuses, obviously the wage increases I've mentioned. The other big thing we're seeing is flexibility, and trying to get directors of nursing to say, it's probably not the end of the world if one of our CNAs wants to work from 8 to 4 versus 7 to 3. And getting some of our managers who've been long tenured managers to think differently and create flexibility. We've also added a program called Momentum On Up through Truist. It is an employee financial wellness program. It teaches our team members how to manage a personal budget. If you've never bought a car, what do you need to know? What interest rate can you afford? Are you looking to buy your first home? There's 8 pillars of educational programs that they go through. We pay for our team members to have the access to that. The other thing that we've done is we've added UKG Wallet, which is an early wage access form. We have roughly 1/3 of our team members, full-time team members, accessing their wages before payday. The cost is roughly $1 per transaction, so it's relatively inexpensive. But we believe that's really helping some of our team members manage their personal finances. We've added full-time recruiters. And more importantly, as we drive culture, we have to make sure and continue to emphasize our team members know we care as much about their success as we care about our own. So as we look beyond, what does LifeSpire see as a future state? Very similar to what Aaron emphasized, there's going to be continued ownership transitions and consolidations. We are going to be following the hospital industry from 20 and 15 years ago. There is going to be continued for-profit growth. And the challenge we see with that, I see with that, is they continue to try to blur the lines between what is assisted living, what is independent living, and it's going to require us to continue to educate consumers. I know some providers are getting out of the skilled nursing game. I view skilled nursing as a product differentiator. I think having the full continuum will be important. We don't want to have 100 beds on our communities, but we do believe we need to have beds to address and meet the needs of our residents from independent living. More choices and less choices. Aaron referred to this. Consumers are going to want and require more choices, but at the same time, when we're looking at things like constructing cottages, I met with a builder the other day. I said, how do we get this construction cost down? He said, you've got to stop building custom homes for these people. We have to get a little more disciplined in that approach. So how do we strike that balance? LifeSpire is looking for ways to continue to reduce our reliance or dependence on federal reimbursement for Medicare specifically. The capital costs don't scare us as much as some. When you look at it historically, interest rates today are right around the median for the last 30 years, but we know we're not going to return to the markets we saw a year, 2 years ago. And then recruitment retention budgets, we likely believe they are going to start exceeding marketing budgets in the coming years. With all that being said, we believe there's hope. The not-for-profit sector has always driven innovation. We need to continue to do so. We need to continue to lead the senior living field. We think the entrance fees and the tax-exempt taxable debt structures that we have access to is a significant competitive advantage. I think for-profits acquiring these skilled nursing facilities is going to damage the reputation of our industry. We have to continue to do better at telling our story, and more importantly, making sure we're taking advantage of that competitive advantage. We need to be more nimble. As an industry, we typically have not done that, specifically as you share and look at how nimble we are compared to for-profits. We have to continue to be financially viable, build reserves. So when these opportunities arise, you're prepared to look at them, but more importantly, so we're able to fulfill the contracts that our residents sign today, 20, 30 years from now. And we have to just be more or less risk averse than I think we as an industry have been. Again, the only way you accomplish all these things is with a great team. I am so fortunate that LifeSpire has a fantastic team of operators, from our marketing teams to our executive directors, our leadership teams. I'm very, very blessed. We're very, very fortunate, and I hope I enlightened the group today, Rob.
Yeah, that was great, Jonathan. I really appreciate it. I'm sure people got a lot of ideas and probably reinforced ideas for a lot of things that they were already thinking about doing. So that was great. Well, some things that both Jonathan and Aaron talked about were, fee increases, revenue streams, and staffing challenges. So I just want to delve a little more deeply into a few of those things and bring them to life a little bit more. So first, on the revenue generation side, entrance and monthly fees. Jonathan had said that, I think to quote you, you said in terms of entrance fees for a bunch of years until recently, you kind of pressed the easy button and took the 3% annual increase. Well, that's what really we've been seeing communities do, across the country, most of our clients for quite a period of time. And there's really a missed opportunity there that I'm going to explore here in a little more detail, because we know that one of the most important factors in looking at how effective our pricing is the relationship to home values. People are obviously comfortable selling their home and paying the entrance fee. So if we're not keeping up, at least in some way, with increases in home values, I think a lot of communities are leaving revenue on the table. If we're having to look at 8%, 10%, 12%, Aaron said double-digit increases are not that unusual. Is there a way to shift some of this revenue increase into new entrance fees instead of all on monthly fees? So I want to walk through an example of this. And what this chart is showing is in red, it's the median home value, home resale value, starting back in 1990 and running up to July, which is the most recent data. All this was available from the Federal Reserve in St. Louis, which tracks a lot of this and reports out on it. Now, starting in the year 2000, we're saying, what if a community had their pricing right in line with home values as of 2000? And from that point on, we pressed that easy button and took that 3% increase every year, which, quite frankly, I think there are an awful lot of communities that have pretty much done just that. Well, what we're seeing over time, especially since about 2012 on, is we've just not been keeping pace with the increase in entrance fees, and that's definitely leaving money on the table. Now, certainly, these last 3 years have been pretty unusual with a sharp uptick in home values for all the reasons that we know and won't get into today. But when we look at that difference between if we would have just increased our entrance fees 3% and where home values are today, that's a 40% gap. Now, maybe probably more than maybe. It's not realistic to try and close that entire gap because we don't know where those home values are going to go over the next year or so. But it's unlikely that they're going to drop 40% and drop back down. So let's look at just an example of what if we tried to shift more of our cash flow and revenue increase to entrance fees. So we're going to take this fictitious community that has 200 residences, and for ease of math, we're just going to assume that it's 100% full. And let's just say that the average monthly fee is $4,000, and the average entrance fee is what we just saw, that 2,000 community increasing 3% a year to 2022. That's where they would be, right about $324,000 as an average entrance fee. Now let's compare the two. If all we do is look at an 8% monthly fee increase, which is kind of the low end of a lot of what Aaron and, it's what Jonathan did, and it's the low end of what Aaron's seeing being needed in a lot of cases, it would increase the average monthly fee by about $320, which over the course of a year per residence would result in an increase in cash flow of about $3,800. Take that over 200 residences, that 8% increase would increase overall community cash flow by about $750,000. So what if we were to look at entrance fees and not try and cover that whole 40% gap because there's obvious risk there? But what if we were only going to close it halfway and take 20%, capture 20% of that decrease? Well, that 20% in entrance fees is about $65,000, which is equivalent cash flow, one resale at that average price is equivalent to the monthly fee increases from about 17 residences that we looked at over here with that 8% increase. Now, with a typical life plan community having 12 to 13% turnover in a year, typically about 1 out of 8 residences, well, that would mean this 200 residence community would expect to turn over about 25 residences during the course of the year. If they did that, and if on average they got about $65,000, more entrance fee per, residence, that's a potential increase in cash flow of more than 1.6 million, which is more than double what you can get with the with the 8% monthly fee increase. So of course, I'm not saying that you should do entrance fees instead of monthly fees. The real answer is to be able to look holistically at both and figure out what the best answers are for your communities. Now, let's take a quick look at the real estate market for just a moment. Now, certainly, the volume of sales has dropped off significantly over the last 6 months, which coincides with the very sharp increases in the interest rates. However, what's interesting is that there really has not been that much of a drop in the median home resale value over that time period. In fact, the best way to measure the change in home resale values is to look at year-over-year data, because home values are very cyclical, very seasonal. The aberration is these last 2 or 3 years. Typically, home values peak in May, June, and July, and they hit their trough in December, January, and February before rising back up again. That's a typical cycle. So when we look year over year, even with all the impact of interest rate increases and mortgage rate increases this year, the median home resale in the country is still just over 6.5% higher than it was a year ago. So we have to watch that. We will at Loving Company be watching that and updating you all on that as we go through the year. But just something to keep in mind there. So if this is something you really want to be looking at, how can you get the most revenue from entrance fees? There's several things to look at as part of that process. Of course, what we just started with, evaluating your entrance fees versus home values, is one. But two, we can't, of course, ignore the competition and where are they? And there are 2 parts to that. The first is a lifetime pricing analysis, which is a way to compare pricing on an apples to apples basis. Hold on, excuse me just a second there. And the second is to do a positioning value analysis of your community versus the competitors. Those will help you determine if you can really support one, an increase, and two, maybe even a value proposition increase, because the leading communities in a market can support the highest price point. There are also opportunities to really look in detail at internal pricing. Many times we go into communities and we look at their pricing and we figure out, there are some residences that are types of residences that are in more demand than others, and we can, generate more revenue from them. There are also ways to adjust contract options. Even something as simple as taking your 90% refund to an 80% refund, but keeping the price point the same, is a way to increase margin and increase revenue. And lastly, one of our favorite things that we feel is important for all communities to be doing, and that's individual residence pricing. What that really means is that if you have two identical residences in your community, one of them overlooks beautiful gardens, a great view, and the other one overlooks a parking lot, the one with a great view should have an entrance fee that's significantly higher than the one that overlooks the parking lot. That gives consumers a reason to choose one or the other, and gives you a way to capture the value of those residences. So all things to think about. So the next two things I'm going to go over a little more quickly because I'm going to be able to point you to some resources for them. But one is the Early Advantage program. This is something that several communities have done that I found very interesting. What is an Early Advantage program? It's basically a membership program for non-residents of a community. Members pay an entrance fee and a monthly fee. They sign a contract just as if they're moving into the community, except the fee structure is different because they're remaining in their home. Early Advantage programs can be life care, can be fee for service. And partly what they're doing is creating that contractual relationship to be able to access healthcare if needed. And of course, then as they're officially becoming members of the community, members can utilize campus amenities. Now, many people start to ask at this point, well, isn't that the same as, continuing care at home, or as Jonathan mentioned, a life care community, a life plan community without walls? Not really, they're similar, but in the life plan community without walls, we're actually providing care coordination and other services to people, primarily, not always, but primarily with the intent of letting them stay in their home for the rest of their lives, ideally. The Early Advantage program is really a way for people who want to move into the community at some point in time to be able to pay and start realizing some of the benefits, as well as the confidence of knowing that they will have access to those healthcare services. A couple of quick examples: Carolina Meadows down in the Raleigh-Durham area, Chapel Hill. They were one of the communities. Kevin McLeod, friend of mine, CEO, participated in a webinar with us about 1.5 years ago, and I'll point you to that in just a minute. But without going into details, you can see a lot of what they offered. But during the webinar, which is April of 2001, Kevin shared that their entrance fee was $13,500 per person, and the monthly fee was $575 per person, and that the program was generating more than $750,000 per year in revenue, and not incurring very much additional cost to be able to implement. That's a pretty significant impact on a community. Another example, Ben Uncle at Westminster Canterbury on Chesapeake Bay shared this at the Leading Age National Conference in Denver a month or so ago. And some of the information that he reported, they have a life care contract, so their entrance fee is much greater at $76,000 per person. And it says that since the inception of their program, which I believe was right around 2017, they've generated more than $15 million in entrance fees, and are generating more than $250,000 in annual monthly fees. So again, very meaningful revenue impact from these initiatives. If this is something you'd like to explore in a little more detail, Again, we have a webinar and some blogs on it that are available on our website. We encourage you to go there. On the staffing side, two things for staffing. First, and Jonathan covered a good bit of this, the talent acquisition program, which is really the official name for employment marketing. And he's doing a lot of the right things. I won't be too redundant on that. But really, employment marketing needs to mirror all the kinds of things that we do to market the residential living components of our community. And that starts with having a strong employer brand that clearly communicates who you are as an entity to work for and what your culture is and what the employee experience is. That talent acquisition program, we can't just post ads out there and say, we have this job opening. We need to be brand building awareness out in social media, out with various advertising sources, not just for a specific position, but as to who we are and why it's good to work at our communities, as well as then postings that do promote specific positions. So the basics include a very strong career website, using videos and images, testimonials, stories of employees that have grown in your ranks and really developed strong careers. We have to get that out in the market in a number of ways. If you want to see a really good example of this, I encourage you to visit the Success Academy website. Success Academy is a system of charter schools in New York City. If you go to their main website, you'll see a careers link that looks like many of our sites. It just takes you to a career page. But what it actually does is it takes you to a site that's dedicated on employment and recruiting with a lot of information, not just about what jobs are available, but what it's really like to work there, what career opportunities there are. And one of my favorite parts of it is join our list. Imagine developing a wait list of people who want to work at your community. Jonathan talked about Hireology. There are several applicant tracking systems that are out there, but really the basics are exactly what he shared. It has to be mobile friendly. We need to be able to do push messaging to prospects, very succinct job descriptions, very easy to apply, able to respond to them immediately. That's the world we live in if we want to compete. Again, we did a webinar on this and a blog or two on it. Welcome to go on our site and dig around and find that from earlier this year. It goes into a lot more detail on these concepts. And lastly, Jonathan brought up diversity, equity, and inclusion, and the B is for belonging initiatives. And I think this is something that's really important for our organizations to consider. A lot of communities will come and talk to me about saying, hey, we really want to increase the diversity of our resident base. And I really feel very strongly that that's always the wrong place to start. That we really need to, if we want to eventually get to be the place where a more diverse base of residents want to live, we first need to build a very strong base of equity and inclusion and belonging inside our communities. And that starts at the top, board and management, being sure we have that representation there and the understanding that we're doing the training throughout our team to really understand what equity and inclusion are. Why do I think this is such an important thing for recruiting perspective? You know, Jonathan touched on this, the importance of building culture. Compensation is important. He increased their, the average, cost of salaries has gone up 37% in 3 years. That's a really important part of what we have to do to be competitive in today's market. But compensation may attract someone to a community. Culture is what will keep them there over time and reduce that turnover level that's just hurting us in so many ways. We need to be places people want to work. And if we have a really strong, equity and inclusion program where people feel valued and understood, then we're going to be places that people truly do, that diverse people truly do want to work, and to which they'll refer their friends, which is exactly where we want to be. This is my own little, made up, diversity, equity, and inclusion and belonging formula. And what it's really saying is if we can create an environment where equity and inclusion are really fundamental values and part of the culture that's shared, it leads to a true sense of belonging of everyone that's part of the community. And that, over time, will lead to a greater sense of diversity, greater diversity. So with that, really would like to thank everyone, Jonathan and Aaron in particular, for your time today. We're going to shift into the Q&A. Our target was to wrap this up by about 1:30. So that leaves us a little more than 10 minutes. Now, we had a couple of questions here that I'm going to flip over here that looks like they were so I'm going to give some of our speakers the opportunity to share on screen with us answers to some of these questions. The first one, there was a question posed to Aaron on how, on the defaults in the senior living market, how are they divided between for-profit and not-for-profit? And Aaron responded to that one that we'd have to dig into that a little bit, and we'll get back with more detail on that. So not an immediate answer to that. And
yeah, Rob, I can add one thing.
Sure.
I think part of it is that we were talking about kind of the tax exempt issuances, which almost by definition means
okay.
issued by not-for-profits. But I think that one of the things is there are bond issues, tax exempt bond issues that are issued by for-profit providers, particularly in the 142D space, where they're able to access the tax exempt bond market if there's a low income set aside portion. So a lot of the defaults have been among those 142D deals, but again, I can certainly, I know who asked the question, and I will get back to them with more specific details.
Great, thank you, Aaron. Jonathan, one of the questions to you is when you talked about having recruiters and so forth, there are a couple of questions actually around this. One of our participants asked, how many team members do you have that are supporting those full-time recruiters? Any information you can share on like the size of your HR department, how that's changed the number of recruiters, that would be helpful.
Yeah, let me as with everything, it's somewhat of a journey, right, Rob? So we actually started with a recruiter, I'm going off the top of my head here. Let's say two and a half years ago. And we found very quickly that experiment failed. So part of the reason it failed was, your people serving people. At the same time, we were dealing with COVID and just how quickly these labor issues just manifested themselves. So we hired a second recruiter, and that individual, it didn't really work there either. And as we took a step back to say, how do we really fix this issue? That's when we recognized we didn't have the systems and the process and the infrastructure in place. One of the examples I like to tell people is, we had an application that had 97 fields on it. You can't fill that out on a phone, right? So we went to the back of the house team and said, how do we reduce? Well, actually, our VP of HR at the time said, well, we'll reduce the application, Jonathan. They got it down to 45 fields. Still too many, right? I said, guys, I need name, phone number, community, and position you're interested in. That's all we need right now. Obviously, you need an application, but that's what led us to Hierology, right? To understanding we have to have a better infrastructure. So since bringing our latest recruiter on and adding the Hierology piece, we've been piloting that at our first community. We are now in the process of hiring for our second recruiter, and these are our two largest communities. Conceptually, we believe we're going to need three recruiters for our 5 communities. They work at the home office level. The other thing that we've really realized is from a community base, we're really focusing on the full-time employees or applicants, because your communities, as a lot of our operators know, you've got a position of a nurse who works, the third Thursday of every week, right? Well, recruiters can't really dive down to that granular level. So we're really focusing on the full-time status. So in each of our communities, we have either one or two HR specialists. Our larger communities have two. Our smaller communities have one. The community where we piloted the recruiter, we actually have two HR specialists in the community, a director and a specialist, and then the recruiter. And then we have in our home office a vice president of HR and an HR generalist. So I don't know if that answers the question, but that's kind of how we've done it.
Great, thank you. And again, if people are interested in delving into this topic more, that April webinar from earlier this year, Peter Corliss of OnShift, which is another applicant tracking system, was part of that webinar. He shared a lot more information on that. And just like you were saying with your application, Jonathan, the online, the mobile version, that needs to be minimal and quick. And when you get a chance to talk to him, that's the opportunity to explore, things in more detail. You get farther along with someone, you can get the longer application filled out. But, to be responsive and capture people that are out there in the market in the moment, we have to be quick and nimble. So,
Rob, I read a survey. If somebody can't fill out an application on their phone in 2 to 3 minutes, they will abandon the application.
Yep. Another question, was headed my way. When discussing individual residence pricing, what's your definition of a significant difference in pricing? Great question. Now, it depends on the community in terms of dollars. So I'm going to talk in terms of percentages. And it also, varies based on, just how different things are. But I could easily see a 20 to 30% difference in entrance fees between two comparable residences based on view. And honestly, what we've done with a number of communities is it's not just view. I use that as a simplified example. We've taken several different factors that are important to residents when they select a particular resident, and we've basically allocated weight to each. So maybe a residence that is really close to the dining room and other cultural amenities might get a 5% automatic bump up in its entrance fee, and a residence with a really good view might get another 5% bump up. One with a really bad view might get a 5 or 10% bump down. There are other things. Do they have a patio or a balcony? Because there's some communities where some residences do and some don't. You can put a dollar value on that. There are a number of things like that where we've built out tools that basically come up with a unique price. And you may have, let's say if your base price to begin with for a residence is $200,000, you may have one residence that it meets all the greatest criteria, all the best, most desirable criteria, and it could be, at $240,000. And you may have another one that's your dog that's overlooking the loading dock or something, and it may be at 160. You can have some really dramatic spreads, but it all depends on the factors that you're considering for each community. So hopefully that helps there. Another question related to the staffing side of things. So how are we doing on time? Just a couple more minutes. This may be our last question. How do you encourage your clients and facilities to invest in employer branding work? What do you find is a reasonable budget for developing an employee value proposition, an employer brand, meaning like the creative execution of the employee value proposition? Two different scopes of work traditionally. Interesting question. And branding, I don't mean to sound cliche-ish, but it's sort of like, the old saying of, well, how much does a car cost? And, back at the time, people would say, well, are you talking about a Yugo, or a Rolls Royce? Because there can be a pretty dramatic difference. There are some communities that may need to streamline this process. A small single site community is simply not going to be able to invest the same amount in developing a strong employer brand that, say, Jonathan and a 5 or 6 community system could, or that like a LifeSpace communities with a dozen or more communities, or an Axe could with 25 or more communities. There's scale to each of these that really comes into play and affects it, that makes it hard, to really come up with, a specific guideline. But if you're a single site community, and you're looking to really figure first, and define that employer value proposition, that could be anywhere from 15 to 30,000, maybe somewhere in that range. Branding it and really taking it and extending it into all the materials that you need. Well, let me just come at it this way. There's no fixed estimate for this. There are a lot of variables, but Jonathan said that, and I agree, it's becoming so important. There are a lot of communities that may need to be investing more in their recruiting budgets than they do in their marketing budgets. And that's often to the tune of $250,000, $300,000, $400,000 a year. And that's when you get into thinking about your ATS, your applicant tracking system. The brand development would be a one-time thing, but then you've got all your ongoing marketing costs, your social media presence. How do you really build yourself as an employer of choice? You could easily be in that range. Again, depending on the size of the community and the extent of your need, please don't take those as absolute numbers. They vary by organization, size, depth of problems, but it can be a significant investment. If you turn it around, we worked with a community who had to close 3 10-unit greenhouses. Skilled care, average daily rate more than $300 a day. That community was losing more than $300,000 a month, between $3.5 and $4 million a year in revenue from having to close down these greenhouse skilled nursing because they couldn't staff it. So, and that was entirely, they could have filled it, they had the referrals, they didn't have the staff. So the investment in the recruiting can be an investment just like it is on the independent living side or any other, the residential side. It's an investment in being able to earn revenue from all of your business units. So that's my thought there. We're 1:31. We pushed the minute past. Thank you to everyone who stayed out there with us this whole time. Jonathan and Aaron, thank you both so much. Everybody out there probably doesn't know how much time goes into planning your sections, meeting with us, interviewing for the blogs, doing rehearsals, and actually being here today. So, you've been extremely generous with your time and thoughts and sharing it with the senior living field, and we're hugely appreciative of that. So with that, thank you, everybody,
Thank you.
and I hope you all have a great holiday season.
Thank you, Rob.
Thanks.